This is a new video. This is called Trading Like a Bull. And it's interesting I say that because we're having a pretty red day. That actually is going to work in your favor. So, although the timing for my video is probably off, we've had a green day pretty much every day for the past 2 weeks. So far, this is probably the first seriously red day, but the day's not over. We still have 8 hours left. This is a different video. This is a theme video. This is going to be a shorter one. We're going to talk about like bull market conditions, so to speak. So the idea here is a lot of you guys maybe not have gotten in. I told you guys before I gotten in pretty low, so I've been very comfortable. But some of you guys may not have been. Some of you guys had to wait. Some of you had jobs to deal with. Maybe you don't have the a good enough capital to deploy. There's different variables, right? And I'm not judging. And we shouldn't, right? We should always kind of work together in this regard. So this video is going to be designed to help you learn how to trade when the conditions are optimally at its most bullish. Because what happens when you get something like this? How do you trade this, right? That's going to be important. And so, although today probably isn't the best time for this, this will be a video that you could watch for months ahead of time, even years ahead of time as we get to a very strong bullish market cycle. And I'll be honest, most of these I learned during during the height of the last bull cycle that we had in about 2020 or 2021. So keeping that in mind, I've got 7 things. I'm going to go over them briefly. I'm going to try to cover them as much as I can, but also restrain the videos. I don't want to make this another hour video like I usually do, and for your sake. So anyway, let's get started. We're going to go down the list to see how you can trade like a bull. Now, the first things first, before I get into it, I need to talk about a couple minutes about the nature of bullish price action. When we have that, by default, things are going to be trending, right? So that's the whole idea. The market can, I can talk months about how the market is psychological, things like that, but we can boil it down into 3 different categories. It's either ranging, or it's trending bullish, or it's trending bearish. So really it's technically two. It's either ranging or trending, and then the trending is just bi-directional. It could be up or it could be down. So in the bullish case, you are already narrowing this down to where you are not dealing with range price action. You are dealing with trend price action. And that is a absolute key to understanding the 7 things I have and understanding trading bullishly in general. Um, I used to be a trend. I still kind of am a trend trader. I'm an A-Rin trader, which works on trend and momentum and liquidity all at the same time. But it helps that I have a trend background. And if you are used to trading trends like EMAs or MAs, for example, this will be of more benefit to you than someone who does pure price action. It's hard to get in and trade price action, especially when you have something like this, let's say, and here's your top. And so even pure price action traders wouldn't even do this. This is just how I've learned how to do it as a trend momentum liquidity, Apex. That's what Apex stands for. ARUN, price action exponential. So when you have a breaker like this, my expectation is that it would come down, but it's still trending higher, right? And so we have other things at play. We have a RSI divergence to work with. We also have a hidden bull div, which I'll get into hidden divergences in this video. There's a lot of misconceptions about that, and it's they're not what you think they are. We think about them too much, but we'll get into that. So we have all this at play. A price action perspective would either be too long right here, which is tough because let's say you long here right at the close, you have a pretty significant wick. Like your wick is almost 10%. So that's really too wide of a stop. It's also not close enough. Like even if you try to do a tight stop, like you're still working with 5%. A lot of people want to have a very tight stop towards the retest area, and that's great, but we haven't gotten that, right? So how do you do that? And so I think the first thing to keep in mind, this is not on the list, but the overall perspective, I should say, is to think like a trend trader instead of a price action trader. That's going to help you on your journey. Now, if you are pure price action, then I do apologize for that, but it will help you to have a trend mindset, right? So keeping that in mind, let's get started on these 7 things to trade like a bull. All right, so the first one is going to be small trend reclaims. And again, it helps that you get a trend perspective overall. And two, some of these are going to look cheesy. I understand that. But the thing is, we have a misconception about how we trade. And I've talked about this in many observations videos and nowhere market update videos, I believe. But the general idea I have is that people try to be too smart with their trading. And so we've talked about this in the CT world that sometimes the best trade is the 20 IQ trade. Sometimes the best trade is the dumbest looking one, right? So keep that perspective in mind as well. Now, things become the dumbest when things are most bullish, correct? So we can work with that. And honestly, one of the most effective ones for me was just trading the moving averages on lower time frames, and also with Arun. And I'll get to that in just a second as well, because Arun, although I use the Arun the most, I use it more than I do my moving averages. I know most people don't use Arun, so I'm not trying to convince you to use a certain way, but we'll get into this. So on the daily, so you can see here, we had all the moving averages, right? So let's say, you wanted to enter, I entered somewhere around here. My buy signal was, well, I had various ones. Anyway, let's say you bought in here, right? But you can't, you're looking at this candle, it just keeps going up and up and up. You missed out, right? Your favorite influencer did this, and you have missed out. You have sideline money, things like that, right? And so let's say, like, look on here, it's 3.68R. So we could even round it up to 4 if you want to, just to make things harder for you. And so I'll write that down, 4R, and then 23%. Well, now we're lower a little bit now, so 21%. So let's look at that. We got 4R, 21%. And so we'll do that. But then let's go to the 4 hour and see. And so these are moving averages. So what I want you to know is that this red line is an EMA 100. And so obviously that represents the exponential moving averages. So when you're dealing with trends, you don't want to deal with simple moving averages as much. They're too smooth. They're also called smooth moving averages. They're just too smooth and not reactive enough. So at the minimum, you would want to use an EMA exponential, which it gives more weight to recent price action than previous price action. So SMAs are typically for long-term spot kind of scenarios, legacy money type of thing, or EMAs are more reactive to current price action. So this is your 100 EMA. This, however, is a triple exponential moving average. It's TEMA, and that's one that I use. I've used quite a bit in the past. I don't talk about it that much, honestly. But it's triple exponential moving average, so it gives you triple the weight on the current price action, so that it helps you trend more, or helps you find the trend more. So this is the 50 TMA or TEMA on the 4 hour time frame. So why is that important? Well, I can look and I can buy the trends, right? So for the one day, you could say here, let's say I wanted to buy, you could buy both of these here at 27, 300, and you would have missed out, right? And so let's go ahead and mark this out. So you would have tried to buy somewhere in this area, right? And so let's go to the 4 hour. So this is your area that you would have missed, right? So now you still would have missed this on the exponential 100, but the TEMA would have helped you to buy in. So you could have bought in right here. And so honestly, it's just as simple as buying the cross on this. So you could have bought there, but let's buy here, make the stop wider. Let's make it harder on ourselves to try to get the best results that we can. And so let's say you monitor that until you get to here. So now you got 1.96 at 4%. So 1.9 at 4, let's just say 4%. So, and then we're going to go ahead and do that again. You're going to do the reclaim on this, and this is dead simple. I know this is cheesy, but just keep watching. So this, you could put your stuff. If the My general rule is, if the wick, if things are trending, things are not going to go down, right? So it's trending bullish. So you can safely, if you have a big enough candle, you can generally put your stop loss at the candle close or the wicks, and so you could work with that. And so now you can do this right here. So now you're all the way up to here. So you could do one of two things. One, you could cut your position at the divergence. If so, that's 13% at 5.69. So let's say 5.7. If you did not want to do that and you cut at the close, you would have got just shy of it at 5.4 at 12%. So it's it's just fine. So wait, what did I? Oh, yeah, okay. Sorry, I thought I messed up here. So you got that right, and so now you have. Here, let me get my math here. So from the one day, you would have gotten a four. Sorry, my battery just died on my other phone. So get my other one. I've got like three. So and two of them are dead right now. So you got 4R. So from the daily perspective, we had a 4R, right, and 21%. From these two alone, we have 1.96 plus 5.7. So you made 7.6R. So you actually made 3R over what you would have done on the daily. Okay. So, and I say that as a high time frame trader myself that bought in on that daily, right? You can spend more on something like this, right? So that plays into it. So if you're working, let's say you're working with 30,000, let's say I say that because Bitcoin's basically almost at 30,000. Um, you would have gained, let's see, $2,300. So that's pretty good. So the reason I say that 30 is a nice round number for everyone that they can understand, right? Some people have more, some people have less, but it's a good solid number to work with. So these two trades alone would have gotten you $2,300, or really just almost 8% just on these two trades, just on this very simple strategy. And people don't seem to understand this, right? So just keep that in mind. And so we would have also got stopped out on this one. So also keep that in mind. So that would have been like 6.6R. And, let's just do the math here, I guess. So this would have been your entry. Your stop probably would have been somewhere below here. You would have been stopped out, but you would have lost 1R, but you would have only lost maybe 2 to 3% overall. So that takes you down to 15%. So instead of getting 4R and 21% on the daily, you would have gotten 6.6R and 15% on the 4 hour. So that's I would say that's a pretty good consolation. First of all, that's more R value on a lower time frame after the run already started. So that's a pretty good deal, I think. And then the percentage is a little bit less, but that just depends. I don't work with percentages. I work with R values. So you can also do that on the 1 hour, and that gets a little more complicated, right? You can see, like, if you got on the run, you could do something like this, but that gets more complex. And so, but the thing is, the more trendy it is like this, the more you should go to lower time frames. But keep in mind, the lower the time frame, the riskier that trade becomes. So that's the first one. Small trend reclaim is what I call it, and that is one of my favorite ones, to be honest with you, because it just helps and actually can get you more money than actually just buying high time frame. So going on the second one next. All right, so the second one is called the Darvas Box. This is one that I've worked with before. This is based off of some guy from the 50s that learned how to do this. He actually was a tap dancer, show business guy. He learned how to do finance on the side using newspapers, and he did it by doing something called the Darvas Box. And what the Darvas Box is let's say you have this candle here, and let's say you kind of just, you cut it, and this is now what you have to work with. So let's say this has ran up and you don't know how to trade this, right? We can even go to the 4 hour and try to work with this. So the rule with this is you can create a box. So you can do that at any time. So you can do it here for like so. You can basically get a range. So this is basically range breakout trading essentially. But there's one small rule, and the rule is it needs to close above the high here. So you incorporate the highs, and so you do all that there. Go ahead and hit the play button, and we'll kind of see how this operates. So that first wick that you saw would not be what we do, right? It would have to be a candle close. So this is your candle close. You put your entry at the candle close onto the upside, and you can put this wherever you like. If the range is small enough, I tend to put it on the low side. It depends how trendy it is. You could do half, something like so, and then we're just going to hit play, and depending on where you want to go with this, and that is going to the upside, and you can see that again. So again, working with this, we know that if things are in a bullish mentality, things are going to trend bullishly. We need to always have that perspective and that foundation that a bullish market is a trending market. Okay, so you can't necessarily play ranges like they would normally. You can play range breakouts, and range breakouts will take more precedence over rejections, right? And so rejections will happen least often. So we can kind of continue with this here. And I believe it does go to the upside. And so here is your divergence. So you would pretty much stop it right there, and you got a run of 13% at 4R. So that's pretty good. So that's what Darvas is. It's very simple. It's basically range breakout trading where you trade at the candle close high, but the candle close has to be above the previous high. That's the only stipulation on that. So that's Darvas. On to number three. Now, number three is just a general retest. And so these are a little trickier because they don't happen as often, right? We mentioned that in the intro that these don't typically retest. Now, except for when you go to lower time frames, because when you go to lower time frames, things will always retest more and more. So that's something to keep in mind. So this didn't retest here. You had the upswing. This consolidation did not retest either. But then we also had this marker here. So what you want to do is once you get a consolidation like this, you can map out your level like so. This is your retest area. If it's supposed to be a trending market, it's not necessarily, it should not retest technically. So this number three is going to be the lowest probability, but it's going to give you the highest reward. Because if it happens and the market is still trending bullishly, then it should still maintain that, right? So this is your retest point, and so here's your second consolidation, and so you can mark it out like so. You can do wicks or candle closes. I tend to do just the bars themselves, and so with this one did retest. So this is where you could put your entry level, and then you could put this either at the range low or you could put that at the wick low, whichever one you desire, and then you can just hold it. And this one, you know, is only about 1.69 at about 3%, but you're also dealing with the 30-minute time frame as well. So that's another way to do it. Not necessarily the most efficient, but when they do occur, you tend to get the low when it comes to bull markets. So keep that in mind. The benefit of that is you get the low. The con of that is you don't really know what you're messing with after that. So on to the fourth one. So number four is a very controversial one, I want to say. And this is hidden bull divergences. And so I say that to say there's a lot of controversy surrounding hidden bull divs. A lot of people don't even believe that they're efficient. Some people will even sarcastically say, well, if why are they called hidden if you can see them? Like there's that play on words to kind of ignore the idea that they're a thing and even why that they're a thing. So the misconception about hidden bull divs and so number four is going to be dollar cost averaging in hidden bull divs, and I'll get to that in a second. But the misconception about hidden bull divs is that if you see a hidden bull div that you think, okay, we're going to go up. And that's not the case. Hidden bull divs are not designed to go up necessarily. Now, why are they even declared? So the biggest declaration of that is that when you get a bearish divergence and you also get a bullish hidden divergence as well. And so an example of that would be actually current price action. So we're on the 4 hour. So what we had here is we had a divergence here, so to speak. Kind of had like slight double top, but that is divergent in its nature. But we also had a hidden bull div, and so that is like so. There's your hidden bull div. There's your there's your bear div. There's your hidden bull div. Now, when you get them together, I have to emphasize this: the hidden bullish divergence will only work when there is a clear bear divergence. So they work together. So what you do is you buy when you see a bear divergence mixed with a hidden bull divergence. And so that would be your entry. And then you could put this probably wherever. I'd put this below the consolidation, and then you could do that, and then you got your trade with that. That's a pretty good trade, subjectively, right? It would be different in real time, but that's another way to navigate that. If you see a bear div combined with a bull div, that's where you go. Now, sometimes they don't always happen that way, and that's why I say DCA, dollar cost average. So like they might go a little bit lower, but that's okay. And so you also have um, another one right here. You have a lower low with that, so that's good. So you had another upswing, and so this kind of continues. And so we also had another one here. You have a bearish divergence, and then you also had your hidden bull div like so. So I probably should put these down here. It would make more sense. So that's what you got to work with, right? So and all two of those went up straight up afterwards. The other one, the price point is roughly around the same price of where it was. So you got to keep that in mind. So DCA hidden divergences, not necess- not it's controversial. I understand it doesn't always work. I will admit that, but it has been one that has helped me navigate the price action. And then you can also incorporate the Darvas with that to do range breakout. And so that's the thing. You could incorporate this as a range instead if you wanted to be safer. And you can use multiples of these at the same time. Then you got a very nice 2% stop, and then you got your divergence here up the top, and you could do a 10R, or even if you went down here, you still got the 2.5. So that works pretty good. So that's number 4. On to the fifth one. All right, and so number 5 is just consolidations, and so this will feel similar to Darvis and to retest points. So we're going to do the same thing. Let's just go on the 4 hour even and kind of work like so. But when you get something like this, you're going to get a consolidation. So when you get, let's say you get a high and then it starts to go down, now this becomes a range, right? So your range might be like so. Let me kind of zoom in. So your range might be like this, but then when it goes down even more, then it becomes like this. And then when it extends, it comes out like so. And so now you have a few different things. You could long this scenario, which obviously that would be a fake out, but this would not have been a Darvis because it didn't go up above the wick. So that's one reason I use Darvises over some of these other ones as well. So this would have continued, and then this would have honestly continued all the way up to here. So this is your consolidation. Actually, this technically is your consolidation range breakout. But if you put it up closer with this deviation, this would have been your deviation breakout. It would have been above your wick as well. So that's where I would have played that scenario. And so this works out like so. Put your stop below the opposite side of the range. Sky's the limit as far as the top here. So you got like a nice healthy 5R with 19%. So overall, that's consolidation. It's very easy. It's basically range breakout trading as well, but more of a simpler um, aspect to it. And so that's another way to trade this bull price action. So on to 6 and 7. So 6 and 7 are actually together, and that's basically like triangles and continuation patterns, I should say. I had something written differently, but I should probably advertise it as continuation patterns. So they're similar in scope, but let's say we'll use we'll use this as an example. So you almost kind of have like a triangle pattern, like or you did have. Let's see if I can find a better example here. Um, on the move up. I think that's probably what we got for this scenario. And so well actually we did that recently right here. So let me sorry, I'm kind of stumbling here at the end. So we had a consolidation like so. Now this is before this price action occurred. And so you had a trend line like so, and then you also had something like this. So this is your triangle um, continuation pattern. So typically what this does is it's a buildup of demand matching with the supply and trying to work with that. And so when you have that, typically it's a sign that it's going to go up, not down. Now, currently the price action is like so. If we can recover this in the next 3 hours, I think this is actually a really good retest. But we'll see. And we're also at the retest of the 50. By the time I get this published, I won't be able to explain it either. So I apologize. But with this, typically you get the range breakout. That's a good way to look at it. If you get a consolidation and a triangle, it is a good method to look at breakouts for that as well. So it's a combination also of consolidations as well and breakout trading and Darvas trade. So a lot of these are very similar, right? So honestly, I only use maybe like one or two examples for moving averages. And you can use the moving averages in tandem with this. So that's the video. That's six. That was 6 and 7, by the way. So that's the video. I hope you enjoyed it. Try to keep it a little bit shorter this time. 7 ways to trade like a bull. I'm going to try to follow this up maybe the next couple weeks and see how this goes. See if I can give you some better examples in real time and working with that. So I hope you enjoyed it. I hope you enjoyed this video. If you like it, like, subscribe. Trying to build my channel. Also, if you're interested in any scripts at all, I've been doing live back testing. I've already done 2 hours of live back testing, and I have an amazing script with amazing results. Go ahead and check that out. I'll try to link it in the description or at the end of this video. Hope you have a good day. I'll see you next time.